Welcome at Encavis. We disclosed this morning our full year results 2021 and gave guidance for the current fiscal year 2022. To make a long story short, the results of the past year were above guidance and high above analyst consensus. The guidance surpassed the expectations of our 12 analysts. If we go into the details of the past fiscal year 2021, there was a positive growth effect of our latest park acquisitions, mainly the large or two major projects in Spain, La Cabrera with 200 megawatt peak generation capacity and 300 megawatt peak generation capacity in Talayuela. The one park, La Cabrera, contributed to our earnings and revenue for a full year, Talayuela for a 9 months period, and so we will benefit from this park in the current year for the first time with a 12 months effect. Despite significant weather deficiencies we had in the Q1, especially in the past year, and mainly in wind, a very strong price increase in the fourth quarter 2021 more than compensated for this, and that's why we more than fulfilled our own guidance and the analyst consensus expectations as well. May we have a look in detail to this? So revenue increased by 14%, same with operating EBITDA. So very stable operating EBIT margin of 77% past year. Operating EBIT increased by 13%. So we are close to the 45% EBIT margin as in the years before. And operating cash flow had an extraordinary good year with 18% plus. So this was a lot more than expected. And so for the current fiscal year, situation should be similar. Operating earnings per share increased by 12% from 43 € to 48 €. Guidance was 46 €. So even down there, we were much better than expected. And this in a year with just ordinary or on average weather conditions all over the year. Some of the quarters even below the average of the year, but as I said, more than compensated by high energy price increases in the fourth quarter. If we go into the details of the figures a little bit more, you see that we were above guidance as well, with 4% in revenue, 7% in operating EBITDA, 8% in EBIT, and cash flow extremely 20% plus. So the guidance we confirmed throughout the year 2021, more than twice were fulfilled in a very nice manner. If we go into the quarter, you can see the effect in the fourth quarter and in the third quarter, how strong the revenue have increased compared to the year before. And this was extremely well to be seen in earnings per share. Normally, the fourth quarter could be a negative or a very weak quarter, but due to the high energy price increase, the fourth quarter contributed 11 € of the 48, nearly 1/4 to the earnings per share throughout the year, and more than compensated the loss in the first quarter. So seasonality in our business have been completely different to an ordinary year. Equity ratio increased tremendously from 26% to 33%, and this is due to the issue of our hybrid convertible bond, which will be accounted under IFRS as 100% equity. As you may know, we issued a hybrid convertible bond in the nominal amount of 250 million in November last year. Therefore, equity ratio is at 33% on a record high level over the past 10 years. If we go into the details of the past year, you could see that solar parks dominated by more than 70% of revenue portion, revenue and operating EBITDA. EBITDA margin increased from 81% to 82%, and operating EBIT margin increased to 49%. In wind farm, we see that revenue is nearly at the same level as the year before. Production was below the year before. Only the price effect gave them the revenue on the same level. Operating EBITDA margin increased as well to 81%. In operating EBIT margin, we reached the 45%, which is the long-term average within the group with our wind farms. Technical services are much below the year before, but the year before benefited from a 2.9 million EBITDA effect because of an internal sale of our Stern Energy entity into Encavis Technical Services. So what we see this year, this is a normalized year in technical services. To be honest, technical services is not the earnings contributor, and they assure that our solar parks will be 98.5 to 99% available on a technical basis to secure the revenue in the solar park business. Asset management succeeded very well in the past year, close to 20 million euros revenue and a very nice EBITDA margin of 43% and operating EBIT margin of 40%. And we were able to reduce even the cost level or stay stable despite the growth of the group in our headquarters. So cost efficiency, one of the main topics within the group. So if we compare this with our guidance, you see a lot of green marks everywhere. Only in the wind business, we did not fully succeed or fulfilled the guidance we gave for this segment. But as I explained before, various weak first quarter 2021. So that's typical topic. Wind is very difficult to forecast. Solar is much easier. Same with the other segments within the group. Dividend policy, as you may know, we gave a dividend promise in the year 2017 to increase the level of our dividend payment per share by 50% over the next 5 years. So the 20 cents, which were paid for the fiscal year 2016, should be increased to 30 cents for the fiscal year 2021. This is exactly what we would propose to the AGM for this year. And so we fulfilled our promise every single year by an increase of 2 cents per annum from 16 to 2021. Payout ratio for fiscal year 2021 will be on the very high level of 63% and compared to the 48-cent earnings per share we achieved in the past year. So ratings nearly unchanged. I would like to focus now on guidance for the current year, and we positively surprised or surpassed the analyst consensus for the current year. So we expect revenue above 380 million for the current year based on the portfolio of energy generation capacity as it was end of last year. So all the acquisitions we would like to do in the current year, mainly up to 500 megawatt capacity additions to our existing 2 megawatt portfolio. They are not included in this planning. They will contribute to the revenue in the year 2023. But based on the portfolio of end of last year, the guidance is made for the current year. So 14% increase in revenue, 11% in operating EBITDA and operating EBIT. And the operating cash flow will be above the very high number of the past year. And operating earnings per share will increase, you may say, only by 6%. But we have to have an account that on average, we have 16 million shares more for the year on average. So the current number of shares outstanding is 160.5 million shares. The calculation for 2021 was only 144.4 million shares. This is due to the conversion of our hybrid convertible bond in October last year. So for the current fiscal year, we even have more than 10% more shares outstanding. And despite this, we will increase our earnings per share even by another 3 cents per share to 0.51 euro. Energy production in gigawatt hours will exceed more than 3,000 gigawatt hours or 3 terawatt hours this year. So will be an increase of 9% as well. You see, energy production will increase by 9%, revenue and earnings will increase by 2-digit numbers. This is the effect of higher energy prices for this year than compared with the year before. So give you some insights on the guidance we gave for the current fiscal year. It's not only above the average of our analyst consensus, is in most of the figures even above the top extrema of the analyst consensus. I'm sure we will be more precise after the Q1 and Q2 figures of the current year. If we look into our segment guidance for the current fiscal year, we see solar parks are dominating again a revenue and earnings situation with an operating EBITDA margin above 80% and EBIT margin around 48%. But if the wind parks or the wind farms will fulfill the guidance, then they increase their operating EBIT margin also to 47%. And asset management will be similar to the year before. So we are looking forward to do this. And maybe to finalize the presentation, you have seen that we fulfilled our dividend promise over the past 5 years, every single year with an increase. For the future, our dividend policy may focus on a lot of different impact factors. And as a growth company with a strong growth and accelerating growth even, we would focus then at the end of the year on a lot of different topics, especially earnings power, cash flow, investment opportunities, growth potential, to define then every single year about appropriate and competitive dividend payment every single year. So no 5-year medium-term dividend promise will be given as in the past, because growth will be the main factor for the future. And we are convinced that if the company is growing, the earnings are growing, share price will benefit from this as well. And then dividend given to our shareholders will be maybe a minor important issue. For the current fiscal year, the dividend will be offered again as a cash dividend and scrip dividend in shares as well. So this will be our policy. We did this for the past 8 years. We will do this for the next years as well. So thank you very much for your attention. And if there are some more questions, please feel free to contact us at any time. We are at your disposal and looking forward to lively discussions with all of you. Thank you very much.
Since you watched this company video until the end, I'm guessing you liked the video. That's probably because we work very hard to create the most engaging and value-added content possible for you. If you're a stock-listed company or corporation and want to find out how we at C11A can make a company video with and about you, please email us at community@c11a.com.